Crop conditions across Nebraska continue to deteriorate. The latest USDA NASS report labeled 32% of soybeans and 33% of corn as poor to very poor. With yields continuing to decrease, farmers this year will be forced to lean on crop insurance. Because this year's payments should surpass the $10.8 billion paid to farmers last year, there's concern that insurance companies won't be able to pay the whole bill. Art Barnaby from Kansas State dismissed that possibility when we talked Thursday. Art said the other common question from farmers regarding this year's revenue protection coverage was the maximum price limit their contract would cover.
Well, first of all, it's based on the harvest price, which we expect to be higher than the spring price, and it's measured during the month of October for this part of the country. For corn, that price would have to exceed $11.36, and for soybeans, it would have to exceed $25.10. Currently, neither market is anywhere close to the limits, and I really don't expect us to exceed the limits. If somebody's really concerned about it, they could go out and buy $11.30 calls on their corn and turn their insurance contract into an unlimited contract, but I'm not recommending that.
There's a possibility here that if the harvest price does go up and yields continue to go down, that some farmers could come out fairly well from this, yes?
Better than they did in 1988, which is the last big drought. And in 1988, most of the coverage was yield only at 65%, and very few acres covered. In some states, less than 15% of the acres. Fast forward to this year, on average, more than 80% of the corn acres are insured, and most of it's insured with revenue protection, and most bought the harvest price. So not only are there more people insured, but at a higher coverage level, typically 75 to 80%, and they're being paid based on the market price rather than a price set 6 months earlier.
Now that's a point of discontent for some because they believe that farmers are going to come out ahead on this thing. But as you mentioned, the one thing that people aren't talking about is people who need that corn to feed. So talk about how this relates to the current discussion.
Well, first of all, most farmers have anywhere from a 20 to 25% deductible off the top, so you need prices to go up 20% just to get back to the same level. Very seldom do you come out better with a crop loss than actually raising a crop. Having said that, if you are a diversified farm with both livestock and crops, and you need that corn to feed your dairy cows or your pigs or farmer background lot, that sort of thing, then you're going to have to buy back that corn not at a forecasted price back in March, but today's market price should your crop fail. And there are parts of the country, particularly Indiana, where in southern Indiana the crop is done. I mean, their claims are being settled right now.
Do you have an idea of what we're looking at in terms of total, and obviously the season's not over yet, but what we could be looking at for a total loss? And is there a concern that crop insurers won't be able to pay out all of it?
Let me answer the second question first. Crop insurance companies, after the failure of a company about 10 years ago, must now provide documentation to RMA that they can survive 2 catastrophic losses and with sufficient reserves and or reinsurance coverage. So these companies have the capacity to cover this loss. The other thing that's really changed is in recent years, large companies such as Wells Fargo and ACE, QBE, some of the bigger international companies now own the crop insurance companies in the U.S. They are a really large organization, and the crop insurance part of their portfolio is really a very small part of it. So I don't see any chance that they cannot make these claims because it's such a small part of their portfolio.
Right.
The small companies, if somebody should fail, and I don't really expect that either because they buy reinsurance, but if that should happen, ultimately the federal government's obligated to take it over. Right now, I'm estimating somewhere between $10 and $15 billion underwriting loss this year.
And that's based off of just what you're seeing so far?
That's based off of where we were in 1988, looking at historical loss ratios and comparing what those loss ratios have to be in order to get to a higher level. A $15 billion underwriting loss would require a national loss ratio that's higher than has ever been observed. So it could happen, but that would be higher than any loss ratio ever observed. You have to remember, this is a national insurance book. It's not just Illinois and Indiana and Nebraska. And there are a lot of crops insured now that were not insured in 1988. So you've got a diversified pool of insurance that's much larger in volume, and the way averaging works, and that's what the pool is working off of, it's hard to get those loss ratios as high as you might think. Historically, the highest one we've observed, if our memory serves me right, was about 219. And 219 would not put you at the $15 billion number.
Knowing that crop insurers are going to have to pay out a big number, does that would it surprise you to see premiums spike next year?
Well, if you have a claim, and now I'm speaking as a one with a vested interest in a wheat farm, where we've had claims on my farm. We had drought in 2011 and freeze in 2009. That pulls down your APH. That cuts your coverage level when your APH drops, and automatically your rate per 100 increases. So even if they do nothing with rates at RMA, your rate per 100 will absolutely go up if you had claims. Now, having said that, don't confuse rate with premium. Premiums might be higher next year just because prices are higher. They could also be lower next year because prices are lower. So the market will set that number, and the premium per acre is different than the rate per 100. What RMA sets is the rate per 100.